Jeff Bezos defends Washington Post's move to not endorse a presidential candidate. The Wall Street Journal. As we scroll right here, saying endorsements create a perception of bias. Bezos, who owns the newspaper, emphasized the importance of independence in media in repairing trust that has been broken between the American people and newspapers. Listen, here's where I'm coming from. Oh, by the way, my name is Amos, and welcome to Dividend Compounders with Cheese. I am not a fan of Jeff Bezos, not a fan of Amazon, but I agree with him wholeheartedly right here because here's the thing. When it comes to the media, if a newspaper is going to be endorsing and supporting and saying, hey, this is the presidential candidate that we like, and so should you, it just goes to show you that everything they're going to be producing is going to be filtered through the lens of like, hey, we support this guy and not that guy. And it creates this atmosphere of like, can we even trust anything? When it comes to the press, media, and newspapers and journalists, I feel like having an unbiased, sticking to the facts and speaking objectively is the integrity that allows the audience like you and me to determine what we want to think. But for a newspaper to straight out come out and say, hey, we're going to be supporting Trump, we're going to be supporting Kamala, I just not a fan of it. So in this case, the fact that people are so angry at Jeff Bezos makes no sense. What you want to see is a newspaper saying, hey, we're going to take a neutral approach and we're just going to be publishing the facts and you can decide how you want to feel about it based on your moral compass, values, whatever. Love it. Moving right along. And while we're on the topic of the next US president, check this article out right here. The next president inherits a remarkable economy. The high quality of recent economic growth should put a wind at the back of the White House's next occupant. So where I'm trying to come from is, I just published the video saying like, hey, which stocks are going to be the winners if Kamala wins? And then I published another one titled, hey, which stocks are going to win if Trump wins? And at the end of the day, win or lose, whoever takes over, my investing thesis, game plan, and strategy is still going to be the same. I'm going to be dollar cost averaging and buying into dividend compounders that I have this conviction and faith and believe into. It doesn't matter who's running the country. As long as your timeline horizon is not 4 years, you're going to be fine. Just keep doing your thing. But if you're only looking at it from a short-term lens of like the next year or two, then I guess I understand why your panties are all up in a bunch. But for the most part, I don't really care who's the president because behind the scenes, there's a lot more levers and buttons being pushed that we don't have line of sight to. But anyways, I want to call out some important stuff from this article right here. Look at this. Whoever wins the White House next week will take office with no shortage of challenges, but at least one huge asset, an economy that is putting its peers to shame. So they just published third quarter a 2.7% growth year over year, which pretty phenomenal because it talks about right here, it's outrunning every other major developed economy, not to mention its own historical growth rate. So the economy right now doing well. The stock market right now also doing well. So I'm pretty happy. And to me, it doesn't really matter who's going to win this election because they're not going to go out of their way to put fire onto the stock market and set it ablaze. That's not going to be their course of action, right? They're going to try to do their best and do the right stuff. That way they don't go down in history as the worst person ever. I know both sides like to point fingers and say the world is going to be a catastrophic end if that person wins, but highly doubt it. Most leaders from around the world would trade their economies for the US's in a heartbeat. Through the second quarter, the US grew 3%. None of the world's next 6 largest advanced economies grew more than 1%. Even China is struggling. And that's why when I get the criticism of like, hey, you're dumb, you're not diversifying enough, when I say that VTI is enough, right, set and forget, because VTI is an index fund of the total US stock market, and I say, hey, that's enough diversification to be good to go. I mean it. I'm bullish on the American economy, American companies. I don't see a compelling reason for me to invest into Ireland or into China or into Chile. I really don't. I guess this is me being an ignorant and stupid American, but I truly believe that the best and the brightest companies, they're usually located in the US. I'm not going to sit here and deny the fact that almost every single country around the world at least has 1 or 2 or 3 amazing companies. But when it comes to the US, There's literally thousands of phenomenal and amazing companies, and when you invest into them, you're pretty much going to be okay for the long run, and that's enough diversification for me. And that's why I'm a VTI or a VU type of guy, and I don't see a compelling reason for me to invest into emerging markets or into Africa or Asia. It's just not for me. Estee Lauder shares plunged 21% after it slashes dividend. Okay, so here's what's going on with Estee Lauder, right? Their dividend went from I think it was like 66 cents a quarter down to 35 cents a quarter, and they're just struggling right now. I think they had quarter after quarter of declining sales. Estee Lauder pulled its financial targets for the current fiscal year after reporting another quarter of falling sales. So here's where I'm trying to come from. Oh, here we go. It's cut the quarterly dividend by 47% to 35 cents a quarter from 66 cents. Here's where I'm coming from. In a previous lifetime, I used to be a skincare model. Meaning I used to partner and work with the best makeup artists around the world, and they would use my face as a palette, and consequently I became knowledgeable about the skincare industry. And I can tell you that Estee Lauder, they're going to be in a whole lot of trouble right now, because I said it about a year ago and I'll keep saying it right now. Korean skincare is ahead of the game right now. They are the trendsetters. They are what is hot. Estee Lauder's more luxury brands of skincare is not resonating with Gen Z and with the millennials. And I get it. Estee Lauder is targeting a more prolific and high-income demographic. But at the end of the day, what I think is happening is they are buying skincare products that are based in South Korea. So am I bullish on this company's future? No, I am not. There's one really popular Dividend YouTuber who used to have this in his portfolio, and he loves Estee Lauder. And I always commented on every video where he kept mentioning his bullish investing thesis that, hey, Estee Lauder is going to be in a world of trouble, and eventually it panned out to be true. Like, this is a company where, let's take a look at their stock price right now. So Estee Lauder in the beginning of the year was trading for about $150 a share back in March. And since then, they've just been on this really slow and ugly, and oh my goodness, look at this decline. Almost 52% year to date. And overnight, after they published that disgusting news, they went from like $88 down to $68. Not a good show. This is one of the ugliest things I've seen in a very long time. And yes, I did look in the mirror today. Estee Lauder, you might be looking at it and thinking, wow, this is undervalued. But at a trading multiple of 63, this dividend yield is not accurate. It's closer to I think when I did the math earlier, some napkin math, it's like a 2%, maybe like a 1.9% dividend yield. Not worth it. This is like a company that reminds me of Intel. Once Intel started going on their slow and inevitable decline back in 2021 or 2022, I also thought maybe Intel was undervalued until I did my research and I did some intrinsic valuations, and I saw that Intel is a dumpster fire. And we're going to be talking about Intel here in a little bit, but Intel, Estee Lauder, these are companies that are a dumpster fire right now, and I would not touch with a 20-foot pole, even if there's nipples all around it, because I'm a nipple kind of a guy, but even that is not enough for me to go near this company. So even though it is $68, and if we pull it out and look at it from a 5-year lens, they're at a 5-year low, let alone a 52-week low. And if we do the max, take a look at this. This is terrible. This is a company where if you buy into it right now thinking it's undervalued at $68, it potentially has the ability to go down to $55, $45 a share. Because if you're going to like it at 68, you might as well love it when it hits 45. For me, I am not buying into Estee Lauder. Just throwing that out there. And then next up, we have Bud Light owners. U.S. sales bounce back after boycott, aka AB InBev. Now, full disclosure, I actually had an offer to join this company during my MBA recruiting, and I ultimately decided not to. AB InBev actually went through a PR issue, and a lot of people were angry, and they ended up boycotting and not buying Bud Light. And surprisingly, the boycott was effective. As you can see right here, when they partnered with a transgender influencer, the target audience of Bud Light, as when I think about Bud Light, I think about the blue-collar working class pulling a can or two out of a cooler after a 12 or 14-hour shift at the factory and wanting to just drink it as they watch political commentary and getting angry. When they heard about this, Of course, they were upset because it says right here the angry consumers boycotted Bud Light, which lost its spot as the country's best selling beer. And this kind of reminds me of what happened with Target last year, which is a mega retail company pretty much doing the same business as Walmart because they decided to go all out for Pride Month. And when I saw that happen and the company going on a huge dip, I bought into Target like there was no tomorrow because from my research and intrinsic valuations, I saw that Target was absolutely undervalued. And I come from a background of supply chain and operations, and I know that Target is actually running a pretty good show. And for me, when I think about like boycotts and stuff like that, as long as I know that it's temporary and it's not going to harm the company long run, because believe it or not, most of their consumers are probably back to drinking Bud Light. Most of the Target customers that decided to boycott are probably back and shopping in Target right now as we speak. And I remember, I don't know, maybe like 5 years ago, there were so many people upset at the NFL and Colin Kaepernick to the point where there were people filming and uploading videos of themselves taking off their NFL jersey and all the merchandise that they bought and acquired over the years and just burning it. I remember seeing that. They were saying to the camera, like, I'm never going to support the NFL ever again. Or they were like, hey, I was a fan of the Philadelphia Eagles for 20 years. Now I'm never gonna. I'm telling you right now, those exact same people, no matter how upset or angry they were, because they were emotional at the time, when they made that emotional decision, they are probably fans of the NFL right now, and they're right back to supporting the Philadelphia Eagles, the Tampa Bay Buccaneers. They're right back to being NFL fans. So all that to say, when it comes to boycotts and stuff like that, it might concern me for the short term. As we learned from Target and AB InBev, it does have an effect, an impact on the bottom line for about a quarter or two. But most people, when they do this, they're doing it out of an emotional brain. And once they have time to calm down and settle, they're usually going to go back to doing what it is they were doing, whether it was watching the NFL or drinking a can of Bud Light, or shopping at Target. So I guess that's a good reminder for everyone that is watching or listening to this video right now to make your decisions today and the rest of this week based on reasoning, logic, and with empathy. Try not to make emotional decisions in the heat of the moment when you're angry or when you're about to have road rage. You never know who's packing heat right on the road. You don't want to do road rage. You never know when there's a crazy out there. So try to stay level-headed, do some deep breathing, and make decisions with a level mind. Moving right along. Speaking of boycotts, Starbucks is bringing back the condiment bar. Coffee chain CEO calls for decisive steps, including pledge to not raise U.S. prices over the next year. Starbucks is one of those companies that got a lot of heat over what is happening right now in the Middle East, more specifically in Israel. There's a ton of people that were shouting up and down to boycott buying coffee from Starbucks because a franchisee decided to involve politics with some of his stores that he was operating in Israel. And then another company that was also swept into this was McDonald's. Right, there's a lot of people that were like, hey, boycott McDonald's. They're supporting the wrong cause. And consequently, Starbucks did suffer a little bit, and they're still going through aftermath of all the boycotts. But I wouldn't necessarily say that's the only reason why the company is struggling right now, because I think a lot of people realized during the pandemic, like, dude, spending $6 on a cup of coffee every morning actually adds up. However, for most people, that convenience and that status symbol of carrying around a Starbucks cup as you walk into class or into work is worth it. But there's another set of customers that realize, like, dude, I don't need to be buying my coffee from Starbucks. I could just brew it at home and save so much more money and have it taste the way that I want it to taste. And so Starbucks is going through a weird period of time where they need to grab customers and bring them back into their stores. Because check this out, the coffee giant is recalibrating its business and operations after 3 consecutive quarters of declining same-store sales and longer-running challenges at its cafes. Customers have grumbled about long waits and high prices for drinks, cutting into the company's sales and compounding the challenge of bringing consumers back to its stores. Full transparency, I am an investor of Starbucks, and as a guy who does not drink coffee, I think caffeinated bean water is a total waste of money. However, with that said, one of the best business decisions that Starbucks made this year is bringing the Chipotle CEO, Brian Niccol, into the company because he is executing on all of the low-hanging fruit. And I don't understand why Starbucks did not make changes sooner. Check this out right here. Missing condiment bars in cafes became a lightning rod for customers after the company permanently closed them. So, from my understanding, the condiment bars is where you can go to customize your cup of coffee after you pick it up in what, 4 minutes or less? I think that's the promise they're trying to do now, deliver drinks in 4 minutes or less. And then you can customize it by adding a squirt of this or a squirt of that to get yourself a straw, napkins. I can't believe that Starbucks did not reinstate the condiment bar after the pandemic was over. Like, come on, guys. I think what gives me faith in the CEO is he is doing a stakeholder analysis of the customers, like what is their wants and desires and needs, and how can we fulfill it without giving them free coffee. Starbucks patrons have complained that baristas are often too rushed to capture their milk and sugar needs accurately, and the self-service stations were important in the cafes. So the CEO said the company would restore a station with milk and sugar to its thousands of US cafes beginning next year. Our customers are asking for it and we're going to give it to them. Like, that is a CEO that is listening to the people complaining and getting rid of that pain point. Because when you think about it from a company's business expense perspective of overhead costs, what? That wooden steer straw is going to be like a penny or two, especially if you mass purchase them and you get a better deal from the manufacturer and distributor anyways. If that's what it takes to make people smile and be happy, it's okay to allow people to take an extra napkin or two. Like, that's not going to crush the business at the end of the day. I noticed that when a company becomes too stingy and too cheap, like when you ask for ketchup, like at McDonald's or whatever, and they only give you one packet, in the long run, that's going to piss off more customers. We need to go back to giving a handful of ketchup when someone asks for ketchup. And when someone says, "Can I get a napkin?" give them a handful of napkin. Don't give them just one piece of toilet paper ply. Like, that's not the way to make customers happy. Making customers happy is a recipe of them coming back into the store. If they walk away from your store feeling pissed off, annoyed, or irritated, do you think they're going to come back? Absolutely not, because most humans and customers operate with that emotional mind. If they did not have a good time going into a Starbucks or into your business establishment, they're not going to want to come back. So the name of the game is to have them smiling from start to finish. And to be able to get your coffee in 4 minutes, and for them to be able to get an extra pump of sugar and one extra napkin, if that's what it takes to make them smile, bro, I'm telling you, that's the way that Starbucks needs to go in order for this company to recover. Now, next up, I want to talk about a company that I did not recommend when I made my defense contractors and military companies that I would buy in heartbeat. And that company is going to be Boeing. The title here says, Boeing makes another offer to end machinists' strike. So Boeing is currently going through a terrible time right now with their workers versus the leadership. As a matter of fact, they're on strike. And it's costing the company $1 billion a month. And the thing is, the company cannot come to terms and agreement with the workers on their compensation. This is their third time trying to come to a deal. The first one, they rejected it. The second one, they also rejected it, with 64% of the workers voting saying no. And that was a 35% wage increase over 4 years. And as of right now, they're saying, hey, we'll give you 38% of your wage increased in a span of 4 years. And they're hoping that the workers will agree. At this point, I feel like being cheap and being stupid is not the right move. So whoever is in the HR department at Boeing, you gotta meet the demands of the workers. I'm sure it's not unrealistic. And I think one thing that they want is a pension, because Boeing used to be one of the few American companies that still offer a retirement pension, but they took that away. And now they're saying, hey, we can't give you a pension, but instead we can increase the matching contributions for your 401k. So meeting them halfway is a good thing. But what I'm trying to say is, if the workers want 40% and you're saying, okay, we'll do 38%, and they disagree and you're going to lose another $1 billion that month, you're thinking way too short term, right? If you know these workers deserve the wage increases and you're being cheap, you're being stupid. Give them what they deserve. Otherwise, they're going to just job hop and go to the next company down the street. It's not that hard. All that to say, if I'm in a leadership position in Boeing, I would just shut up and just meet the demands that the workers are asking, at least one of their asks. And I think if it's like a 40 or 45% wage increase over 4 years, just do it. Because the alternative is for them to be continuing to strike and for your company to lose an additional $1 billion every month as you guys keep coming back to the table to negotiate. So stupid. And that's also going to put a bad taste in their mouth. So when I think about Boeing not treating their workers right and then the quality control issues that this company is having, would I ever invest into them? Absolutely not. Did I invest into them? Yes, I think I did like 5 or 6 years ago because that was a different Boeing. However, as of right now, they are not the same Boeing that I used to invest into. I sold out of them so long ago that I don't even remember. But if you have been eyeballing Boeing thinking it's on sale or that it's cheap or compared to the other defense contractors, this one is undervalued, absolutely not. Boeing is a mess of a company right now. And if you work at Boeing, then please let me know if my opinion is wrong because obviously I'm saying all of this as an outsider looking in. Maybe they are a wonderful company treating you guys right, but what I think is that they're cutting corners, they're cutting costs, they're trying to take shortcuts, and as a result, their planes are crashing, falling out of the sky, the workers are striking. It doesn't look like a pretty picture to me. And speaking of companies that I would not invest into no matter how cheap or undervalued they look, check this one out. Intel posts more than $16 billion loss of negative net income for this quarter. The chipmaker attributes loss mainly to charges from its sweeping restructuring effort. So right now, Intel is going through this transformation period from being a computer chips company to now being a manufacturer for other tech companies based in the US like Amazon, Google, Apple. That's what they're trying to turn into. And that transition and pivot is costing this company a lot of capital, money, time, and it's a gamble because in the end, we don't even know if it's going to work out. And what I think is that it's an all or nothing bet that we don't even know if it has any fruits to bear because right now they're just losing a lot of money. It is a ridiculous company, and if you think they're on sale, they're not. Let's see what else is happening with Intel. Intel said it expects revenue in the current quarter to be between $13.3 billion to $14.3 billion, compared with analyst expectations of around $13.7 billion. Intel also clarified the size of its planned layoffs. Now they're trying to fire 16,500 people, up from the previous target of 15,000 people. If I work from Intel right now, my full-time job as I'm at work is going to be actively looking for and applying to jobs at AMD, at Google, at Skyworks Solutions, at Qualcomm, Broadcom. That's what I would be doing, knowing that these pending layoffs are happening and that the company is a dumpster fire and they're going through such a drastic transformation. We have no idea if it's going to work out or not. This is a company that I would not feel happy about if I'm an employee right now. The CEO is building a so-called foundry business, manufacturing chips for other companies. They want to be the second largest contract chip maker in the world by 2030, the number one being TSM, based in Taiwan. To help fund this manufacturing expansion, Intel is relying on government grants, $11.5 billion from the 2022 CHIPS Act that we talked about in the Kamala Harris video. All that to say, without the US government being on board and helping Intel, this company is bound to go bankrupt or be seeking a buyout from another major company. Is Intel actually pretty cheap? Right now, they're currently trading for about $21.50 a share. The lower Bollinger Band is $4. The upper Bollinger Band is $61. I have the standard deviation set to 3. But as you can see, the simple moving average is highlighted by this teal looking blue, and their price is way below it, meaning the sentiment and outlook on this company right now is bearish. I'm not alone in feeling this way about Intel. I don't think it's a good company. And if we zoom back into 1 year out, then the company is down by 41%. And it does look like the price is at or near the simple moving average, which means it's okay. It's fairly valued as of right now. And that means the lower Bollinger Band is now $17.26. What about the RSI? The RSI is pretty healthy at 41. What happened right here? My goodness, the RSI hit a 15 back in August, and the price was around $20 a share. I don't know. This is one of those companies where I think it's going to be trading flat for the most part for the next 3 to 4 to 5 years. So if you buy into it, at its current trading price of about $21, it's basically going to stay flat for a while unless they give up and say we can't do it. The foundry business is not going to happen. But at the hint or sign of any good news, I think Intel genuinely does have the potential to skyrocket to like 26, 27, 28, $29 a share overnight. I think Wall Street is literally has turned its back on this company to the point where if you just tell them like, "Hey, I think my farts don't smell as bad anymore." That's enough to shoot this company right back up like 10, 20, 30% overnight. But with that said, even knowing that from an optimistic perspective, I would still not want to invest into this company. It's like, unless you enjoy losing money, I don't see a compelling argument or reason for me to invest into this company when, as of right now, there's so many other attractive and undervalued dividend compounders out there on the market right now. Like, why would I waste my time and limited resources and energy on this company? I want to move on. I don't want to talk about Intel anymore. I think it's a butthole of a company. No bueno. Apple sales hit quarterly record as iPhone business rebounds. The company's smartphone, which accounts for half its revenue, saw renewed growth ahead of the release of Apple Intelligence this month. And that's why I say in almost every opportunity that I have, Apple is never a wrong decision. Apple is probably one of the safest investments that you can make, especially if you are a beginner investor or if you have some capital on hand. I almost feel like there's never a bad time to buy into Apple. Apple is just one of those companies that time after time, quarter after quarter, they prove you wrong. Or if you're bullish and optimistic about the company, they prove you right. In 3 months, right, the fiscal fourth quarter of their calendar year, they posted $94.9 billion. Even though I'm in the green by like a 3-digit percent, I don't know if it's like 100% or 120%, I'm still not going to sell out of it. This is a company that I think is just going to be consistent and is reliable and is a dividend compounder. I have no reason to sell out of Apple. So I just wanted to throw this out there to show like, no matter what the sentiment is on the internet or on Reddit or what other YouTubers say, I really don't care. Because I did my own research on this company, I did intrinsic valuations, and I know that Apple is a fundamentally sound and solid business. I like what I see, and I like being an investor of Apple. I don't regret it at all. I'm not shy about it. I really don't like Amazon as a company. I have to say, and by the way, I'm not invested into them, but I have to say that this is a really solid, awesome company. It's a phenomenal business. But as a worker at Amazon, absolutely not. I would not. But Amazon shares rise on robust demand, surge in AI infrastructure spending. Capital expenditures, CapEx, has reached quarterly record because right now they're trying to build out their data centers and utilizing their warehouses in order to meet that type of demand. Much like Apple, there's almost never a bad time to buy into Amazon. I wish I could practice what I preach, which is you got to take your emotions out when you evaluate and look at potential investments in the stock market, because are you really going to allow your emotions to not allow you to buy into a winning company? And I think that's what's happening with me and Amazon. My relationship with Amazon is complicated because to a certain degree, I do think the company is overvalued when I only take into consideration the retail arm of the company. But when I think about the cloud and the streaming and the AI segments, man, Amazon has a really bright future. That's why I wouldn't be surprised if in the near future, Amazon does decide to split the company with the retail arm of the business going their separate way and then Amazon Web Services going the other way. Revenue from Amazon Web Services grew by 19% to $27.4 billion. The business is the company's main profit driver and has shown renewed strength after experiencing a slowdown in 2023. And even at its current trading price of about $189 a share, I think this company, the sentiment and stock market, they're bullish on Amazon. So is it ever the wrong time to buy into Amazon? I don't know. Probably not, because somehow they always find a way to keep going up. Because does it really matter if you buy into Amazon at $189 a share or even like $181 when you know a year from now it's going to be trading at $210 or $215 a share? Even though I personally think it might be a little overvalued, I think when I take my angry hat off, I think this company is solid, just like Apple, just like Microsoft. Meta reports record revenue, slower digital advertising growth. Meta is one of those companies where I think like a year or two ago, here, let's pull it up. So in late 2022, Meta was trading for around like 120 to like $99 a share, and at that time I saw that this company was absolutely undervalued because I think at the time their trading multiple was literally like an 8. So the PE ratio was like a single digit number for a tech company. And the reason being is that a lot of investors in Wall Street were very nervous and anxious about Mark Zuckerberg and his vision on the metaverse. He was going gung ho about building out this virtual reality place where people can hang out, study, and work in the future. I guess Mark Zuckerberg and Wall Street were not seeing eye to eye. So as a result, the company was just declining quarter after quarter, week after week. And for me at the time, removed myself from all of the commentary and articles. I decided to do my own research and run my own intrinsic valuations, and I found out that Facebook Meta was so undervalued. So I actually went balls deep and I invested a ton of capital into Meta at around this point right here when it was trading for like $130, $100 a share. I was buying so many shares, hands over fist. And then I held on and I was down. At one point, I was down by like, 30%? Not good to look at. And then I was down by like 16%. And as I kept holding on, look what happened to the company. I sold out of it some point like right here. After I made like 100% gain, I sold out of it. But since then, when I bought in, it's up by 300%. So Meta is just, there's a reason why the Magnificent Seven are the Magnificent Seven. It makes my nipples sweaty when I think about how Meta, the parent company of Facebook and Instagram, through their digital advertisements, posting $40.5 billion in sales. Like that it just doesn't make sense in my brain how this company makes so much money. And you have to also keep in mind that Meta is manufacturing and producing those VR goggles that's hundreds of dollars cheaper than the Apple version. I think it's like the Meta Quest 3 right now. And I watched some videos of it earlier today, and I'm not gonna lie to you, I might get one for Christmas. Even though I'm no longer an investor of Meta, I think this company makes solid products all around, right? Instagram, those VR goggles. I'm not too sure about Metaverse, but I think Meta is a testimony to when you can buy a high quality Dividend compounder with cheese on the dip, like right here or at right here, and you know that it's really solid and fundamentally sound, and Wall Street and other investors are wrong and they're just scared about the wrong reasons. It's a testimony, and it reminds me that I should just trust my instincts and my calculations and math and to buy balls deep into the next company. That thought process could also be the recipe for someone to lose thousands of dollars with a gambling type of mentality, but I'm thinking of it from a high quality company perspective. But anyways, the last topic that I wanted to talk about today, oh, just kidding, second to last one, is this. Huntington Ingalls shares tumble on outlook cut. Navy contract delay. Biggest U.S. military shipbuilder pulled its 5-year free cash flow forecast. So what is going on with this company? So a high-level description of Huntington Ingalls. They're a shipbuilding company that builds flight carriers and submarines for the U.S. Navy. They're based in Newport News in Virginia, which was about 15 minutes away from where I got my MBA, William and Mary. And this is a company that I think they only have one customer. So the biggest risk is what we're seeing right now, the consequence, right? The U.S. Navy. I think they cannot build ships and sell submarines for our enemies because of the intellectual property that submarines have to stay stealthed. Or at least that's what I think. Maybe that's part of the stipulation of their contracts with the U.S. Navy. Like, if you're going to build this for us and we're giving you billions of dollars, you can't build this for anyone else. Only us. And so we're seeing the consequences of that, right? So the U.S. Navy and Huntington Ingalls had expected to reach an agreement. However, now they're not so sure. And as a result, their projected and forecasted revenue is going to be a lot less than what they expected and anticipated. And I think that's one of the biggest risks of investing into a company that only has one customer. And I think what's happening is that Huntington Ingalls is not holding up their end of the bargain because they're coming up with excuse after excuse, which might be valid. But if you're the U.S. Navy and you have a deadline of like, hey, we need these XYZ ships by this timeline and deadline, and you can't get it done, Of course they're going to be pissed off, right? And I think Huntington Ingalls is saying, like, hey, we are having supply chain issues and we have seen a significant loss of shipbuilding experience in our yards, meaning people are quitting, retiring, or job hopping. And now they have young bucks on deck trying to do what a 30-year veteran used to do. And so this company is going through temporary headwinds right now, but check out what happened. Their ticker symbol is HII, and year to date, now they are down by negative 29%. Just look at this drop going overnight, going from $250 a share to $184. And when we zoom out to 1 year, 52-week low right now. Zoom out to 5 years, they're trading for about the same price they were back in December of 2021. Their current trading multiple is a 9.8. Their dividend yield is just shy of 3%. So this is a company that I think is going through it. And rightfully so, because the Navy has certain expectations and Huntington Ingalls is not able to meet those. And that's why those contract delays and negotiations are not happening the way they envisioned. And when we take a look at their chart, this blue graph is their trading price on that day, right? And the lower Bollinger Band is this little red pink line. Look what happened. It's supposed to be $220. Huntington Ingalls jumped off the cliff with an RSI of 9.9, and they just penetrated through the lower Bollinger Band and the line of support to the point where this company is absolutely oversold right now and has the potential to fall even further. Because if they pass through the SMA and the lower Bollinger Band, this company is either going to rebound in a very fast manner or go in a free-falling direction like DocuSign did a couple years ago. So it has the potential to become $120 by the end of next week to potentially being $200 by the end of the trading day on Friday. And based on everything that I know so far, like their revenue and their forecast for the rest of the year is cut. They're having negotiation conflict with the US Navy because they can't hold up their end of the bargain. They're having supply chain issues. Workers are not experienced enough on deck manufacturing the submarines. Knowing everything, is this going to be a Boeing situation? Is this going to be a long-term disaster that's going to take down this company? When I think about it, I don't think so. I think this company is going to struggle for the rest of this year and potentially the next quarter of next fiscal year. But I think the US Navy is only going to get stronger and bigger and demand more from Huntington Ingalls to build more carriers, destroyers, and submarines. Because from my understanding of geopolitics, China is building out and strengthening their navy to the point where we need to meet that arsenal and inventory, at least from a national security perspective. So I think when Huntington Ingalls gets it together and they fix their temporary issues, I think this company is going to be back to being normal within a year or so. So it's a long-term play where if I buy into it, I might be in the red for like 200, 300 days. And I'm willing to take that bet. So this is a gamble that I'm willing to risk on because with an investing horizon of like 10 to 20 years, I'll probably be okay. And I think this is a buying opportunity where I'm going to laugh at myself if I don't do it right now, if I don't pull the trigger. Or if I buy into it at $184, $180 a share and a free falls to $130, I might be a little upset with myself. But I think I'm willing to take that risk. So I will be buying into Huntington Ingalls because it is a defense contractor company that is on the dip. It's high quality. I know I probably sound stupid saying they're high quality when they're going through all these problems, but once they optimize their human capital and fix their supply chain issues, I think this company is going to be doing business as usual. So I am going to be pulling the trigger, and another company that I am eyeballing and going to be buying into if it falls down to the right price is going to be Skyworks Solutions, which is a semiconductor chip company based in California. So those are the two companies that I am eyeballing and will potentially buy into this week and the next, or at least for the next few weeks as they trade near their 52-week lows. And just for fun, because the election is next week, we're going to have the next president of the United States, whether it's going to be Donald Trump or Kamala Harris. I wanted to do this interactive electoral college map. So I think they left the battleground swing states neutral. And it's up to us to determine who we think is going to win based on what we know so far. Now, as a reminder, this is just for fun and not who I want to be president, but just based on what I see and interpret, This is just my educated guess. So I think Nevada, I used to live in Nevada. I think Nevada is going to go red. So 6 electoral college votes going towards the Republicans from Nevada. Arizona is a hit or miss because northern Arizona, very conservative, pro Trump. But when you look at Phoenix, Flagstaff, and various college towns, it tends to go blue. But with that said, I think Arizona might go red. So that's another 11 towards the Republicans at 236. First to 270 wins. When we think about Michigan, I think it's going to go blue this year, especially with the overwhelming amount of students and alumni from University of Michigan that are pro Kamala Harris. So we'll go ahead and give Michigan blue. So now they're at 241. Republicans are at 236. Wisconsin, ooh, this is a tough one. I think Wisconsin can go either way, but the pattern based on their neighbors with Minnesota and Michigan going blue, I might have to say Wisconsin's going to go blue. So now they're at 251. I think Georgia is 100% going to go red. I might be wrong, but that's what I'm predicting. I guess we'll come back here a week after the election and we'll find out whether or not I was right. North Carolina, I think is gonna go blue. I'm not sure because there's a ton of college towns in North Carolina. I think about Duke University, UNC, Charlotte, and all those pockets of college towns tend to go blue. But I know that a lot of North Carolina residents tend to be conservative, so I might be wrong, but I'm gonna go ahead and assume that North Carolina is gonna go blue. In which case, it's 267 to 252. The first to 270 wins. With Pennsylvania, I know this is going to sound ridiculous. I know it's going to sound crazy, but apparently there's a historic high of Amish population turning out to vote in favor of Trump. But I don't know if their population is big enough to sway it in the red direction. But with that said, based on the pattern of almost all of their neighboring states being blue, but to their west side, Ohio and West Virginia being red, this one's tough. I think Pennsylvania is going to go red. Now let's see what happens. When it goes red, it looks like Trump is going to win at 271 to Kamala Harris's 267. That's how I think the battleground swing states are going to pan out. What do you think? Who do you think is going to win? And what do you think about this video in this format? Anyways, I hope you have a good rest of your day. My voice is gone. I love you. Stay safe, and I'll talk to you next time. See you guys.